There are several ways for investors to gain exposure to the retail investment market. REITs are a great option for investors who want. A REIT is a company that owns or finances income-producing real estate across a wide spectrum of sectors. Although most REITs trade on major stock exchanges, they can be public or private. There's three types of REITs. Equity REITs own and operate real estate to produce dividends for investors. Mortgage REITs create dividends through debt on real estate assets. And hybrid REITs invest in both equity and debt. REITs let investors speculate on real estate assets the same way they would invest in other industries, through the purchase of company stock or through a mutual fund or exchange-traded fund, an ETF. The shareholders in a REIT earn a share of the income produced without having to find deals, manage, or finance properties. There are currently 170 million American households invested in REITs through their 401k, IRAs, pension plans, and other investment funds. So what are the advantages of REITs? There's typically a minimum investment amount of between $1,000 and $2,000 to invest in a REIT. Plus, REITs allow investors to gain exposure to real estate while retaining liquidity. For example, instead of investing directly in a shopping center, a REIT would be an investment into a retail sector. Typically, investors can liquidate at any time, like buying and selling a stock. A standard REIT is focused on creating dividends for investors, which can create a consistent stream of passive income. REITs also generally have a lower risk than privately owned real estate. While private investments are typically leveraged at between 65 and 70%, that means debt represents 65 to 70% of an asset's overall value. The average leverage ratio for a REIT is often at a more moderate 34%. Another attractive feature of REITs is that they allow investors to diversify risk by making sector bets across geographic regions and product types. This allows investors to hedge their bets by putting their chips in several markets at once. So what are the negatives of REITs? Although REITs make it easier for the average investor to gain exposure to commercial real estate, they come with certain challenges. REITs are taxed at ordinary income rates. This can be a very big tax burden, especially for high income earners. REITs also generally have high management fees and overhead costs. These fees go to executive salaries, administrative costs to make sure a REIT remains compliant to federal standards, and back-end costs associated with operation and management. Another issue is that the sector a REIT invests in can be doing very well, but the REIT itself may not benefit. REITs can fluctuate with the larger equity markets regardless of the performance of the sector in which it's invested in. A REIT might be a good choice for an investor who wants to dip their toes in the water and get a taste of investing in commercial real estate. REITs are a great option for investors who want greater liquidity. The important thing is for an investor to do their due diligence before deciding which type of investment is right for them.